Hello, future billionaires. Welcome back to another exciting episode. Today, we interviewed Joel Palathinkal, and Joel is the founder of Sutton Capital. He has been in venture capital for many years, and he comes on the podcast and shares about his unique approach of building a community and an ecosystem of portfolio
VC
companies.
community, VC ecosystem. So sticking the fork in venture capital by community.
By community, and he explains how he's done all that, and he has fund managers, limited partners, and portfolio companies all in his community, and really finding the best opportunities within that, and his unique approach to that. So, hope you enjoy this show and the insights that Joel shares. If you are enjoying the show, we do ask and thank you for all those that have subscribed and have shared a review. We appreciate that on any platform that you listen to this on, so we can share this with more and more people and get more people invested in the wonderful world of private alternative investments. Thanks for listening. This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors. Welcome back to the Invest Like a Billionaire podcast. I am your co-host, Ben Fraser, joined by fellow co-host, Bob Fraser. And today we're joined by Joel Palathinkal. And Joel is a venture capitalist and entrepreneur, and he has built a pretty incredible community and a global network of single family offices, high net worth investors, and really focusing on kind of the venture capital kind of ecosystem. And so he runs an accelerator for funds, helping funds raise capital and build traction. And then he also coaches and has launched a new LP accelerator, which we'll get into all this later, but teaching investors how to invest, how to build portfolios, how to vet companies and do due diligence. So prior to this, we'll hear all about his background, but he actually has a PhD in modeling and simulation and was building flight simulators for the Navy and Department of Defense, which is super cool. And then kind of jumped into the whole world of venture. So Joel, really excited to have you on here. Thank you so much for joining.
Yeah, thank you. Really appreciate it. I'm excited to be here. One small correction is that I'm not a broker dealer, so don't help funds or startups raise money. But I just kind of built an educational community to kind of connect people. So that's been really great. Just kind of building relationships across both sides.
Yeah, that's awesome. Thanks for the clarification. I think one of the things we loved about wanting to bring you on the show is we've talked about this before, where we have a lot of interest from our listeners in this world of venture capital, private equity, but it feels largely inaccessible to kind of the retail individual investor.
Mm-hmm.
And we wanted to kind of bring some experts that have been in this space, been in this ecosystem.
Yeah.
Referred to us by Ron Shigeta, who we had on the show, who was a biotech venture capitalist. And we really wanted just to hear from you and your background. You're seeing a lot of these funds go through your education program, go through your accelerator. And a lot of accelerators focus on the portfolio companies themselves, which are teaching a company how to scale. And you actually focus on funds. So teaching funds that are going and investing in these portfolio companies how to scale.
Yeah.
So from our standpoint as investors and educating individual investors, would love to kind of hear from you on what do you see and how do you identify these companies, that are going to be the ones that are going to be more successful than others. And, before we get on to that, though, I'd love to hear your background and that's kind of how you even got into the space.
Yeah. So, I initially grew up studying technology, and I wasn't really that knowledgeable on private equity and venture capital. I really just followed, my family and, friends of mine that were either going into the medical industry or working in technology, and just pursued a career in technology and thought I would do an MBA because I had friends that were, changing careers and getting into investment banking. And I thought about doing an MBA, and I just did not, fully go through the process of applying to B school. And just through happenstance, one of the career opportunities that I had lended itself to a graduate program, a PhD program. And, I ended up, working for the Department of Defense, also worked in the media space for some time. And when I was working for the DoD, they had, a big industry was flight simulation. So, when you think about the Navy, and now, I don't know if any of you guys saw the new Top Gun movie, but, a lot of those, aircrafts, a lot of them need pilots to train. So that was kind of the industry that I was in, just building, testing the simulators. And then there was a local university program that had a program in modeling and simulation. And some of the classes also had financial modeling. And I started just building more of an interest in finance because I had such a deep tech background. I went to New York. I met a couple buddies that were working in private equity and VC. Some of them went through the traditional route of going to a top B school, or just through their networks, they got placed at a top firm. And then that's kind of where I really grew an interest in looking at my superpowers. And, a lot of us, probably some people in your audience, they have different superpowers and different skill sets. They come from different walks of life. And, they may not just have the community or just the general knowledge of that exposure to that opportunity or industry. So that was the same thing with me. But I slowly built, more of a community, more relationships around private equity and VC, and then, finally pivoted into VC after being in New York for some time. And then I started Sutton Capital Ventures. Sutton Capital Ventures is a generalist private firm. We invest in early stage, late stage, and the industries that we focus on is mostly just B2B SaaS, consumer tech. And then we also look at deep tech and the impact. And then we've also done a few small LP investments in funds because the benefit of that is just getting access to some type of industry that you may not be an expert in. So alongside those activities, built some communities, which is now branded as just Sutton Capital and its community. So, one of the first communities is educating people in general on how to switch careers or how to learn about private equity and venture capital. What's the difference between private equity, venture capital? Where does, late stage venture intersect with private equity? Sometimes it's a blurry line. And, oftentimes when you're looking at private equity as a career, there's much more financial modeling versus venture capital, where you're really understanding the founder, understanding the problem, really understanding the market size. So just built skill sets through really building a media platform in a large community. Ron Shigeta is a very similar case. I mean, I met him through another warm contact, and through people like Ron and through other VCs, you kind of share notes and share theses on different sectors, and that helps to de-risk investment opportunities from getting those insights from other people. And that program that I launched is just a VC private equity, community. I saw a lot of people magically kind of switching their careers, whether they worked in technology or they're a medical doctor. A lot of them were switching careers from, that industry to now a career in private equity and venture capital. So that was just really interesting to see. And I think just the future of education, we're starting to see education become unbundled. So recently, Google has now released a suite of courses where you can get a certificate and learn like critical skills like project management, product design, and a lot of those subjects and certificates that you can earn from Google actually translate to a specific job. And I think that's where education is evolving. I think we're moving to a skill-based economy. So if you want to learn how to build a website, you don't have to go to engineer, you don't have to study computer science for 4 years. You can take an 8-week boot camp. That boot camp will help you get a job. And same thing, so I started seeing these people break into VC, and then they finally achieve their goal. They're like, look, wow, I got a job in VC at PE. I think I can do this myself. How do I learn how to start a fund? Right. So I don't think there's a specific major in, fund creation, right? You can't go to college and study, fund admin and fund creation. There just isn't that curriculum, because to know that curriculum, you have to be in the industry, right? You have to be talking to fund admins. You have to be talking to other, VCs. And I think that's really where the innovation can start. So I launched another program about a year ago. We've graduated hundreds of funds in 1 year. We bring in about 50 funds every cohort, and every fund that is in there has, some type of track record. They've established themselves, and, there's no fundraising activities. It's really just mentorship and community and content and education.
So just let me stop you for a sec. When you say you bring in funds and you bring in a cohort of funds, these are family offices who want to learn about private equity and venture capital investing. Is that right?
So there's two types of there's GPs, who are general partners at venture funds, private equity funds, hedge funds. And when I say bring in, they apply to the accelerator, very similar to when you think about Ron Chigetta. He ran IndieBio, right? So there's thousands of startups that applied to IndieBio, and then there's a few startups who got selected. So same thing, like we have funds. These are venture funds. Most of the funds are anywhere from 15 million to probably, up to $500 million in AUM. And they're just applying to the program for the educational content and community. And, our reputation is based on picking really high quality, interesting funds. Some of the smaller funds that get chosen are.
Okay, so you help family offices pick venture capital funds. Is that right?
We don't help anybody pick funds or investments. We just built a community. So we have funds that apply to our platform. And then I have a community of single family offices, LPs, institutions, and endowments that just want to be involved with that community, right? Because they want to meet other LPs so they can talk about how to be a better LP. They also want to meet interesting funds. Their reason may be different reasons, right? Some family offices don't want to invest in funds, but they want to invest.
You're building a community of passive investors in venture capital investors who want to be a part of a community, get deal flow, find out who's doing what, get peer up with others that are interested in passive venture capital investing.
Correct. Yeah. So
Okay.
when you think about the people, whenever you build a community, I think you need to think about what everybody gets out of it. So when you think about GPs, general partners at funds, it's a long and lonely road trying to raise a fund and build a thesis around it and, close a fund. Right. So it's very valuable, I believe, to not be alone and be part of a community of like-minded individuals that are on that same journey, especially during COVID. And anytime it's just difficult to raise a fund, right? So it's always more fun if you're not alone. So my goal for fund managers is to build a safe community where fund managers can help each other, be a support system for each other. But what do they really need? They need to meet people that invest in funds. So I've also used.
So it's both sides of the community. You want the guys who are running the venture capital funds and the guys that want to invest in venture capital funds.
Some funds, I would categorize it as two personas, right? One is a GP, a general partner at a fund who's raising a fund. An LP is an allocator that invests in funds.
I understand.
Many of them have to do this for their job. So if you're an endowment fund, for your job, you get judged on the funds that you bring in. And for me, I'm just trying to build a community and what I get out of it is I get to just build a really crazy network. I mean,
sure.
because of the fund accelerator, that's why I'm on this podcast, right? So Ron was in my fund accelerator. He was in the community. So I think when you build a community, there's a lot of intrinsic compounding returns.
And the community is the fund accelerator, right?
That's one of them. So I have three communities. The first one is the private equity VC education community. That was the first one that started. The fund accelerator is a new community, which is a community for LPs and GPs.
Gotcha.
And that's a cohort-based program where every quarter I bring in about 50 funds. Again, those funds apply to my program. I have a community of LPs that give me feedback on which funds they think are interesting, and we pick the top 50. And then, you know, there's LPs. These people, what they get out of it is they want to meet other LPs, right? If you are a single family office, you mainly focused on real estate, it might be interesting to meet another family that has done some venture, right? And meeting another family, the benefit is you're not getting pitched because you're just kind of a peer with another family.
So let's back up for a minute. So our investors are mostly, you know, most people, we have this, what we call the investment continuum, and most people start in the public markets, right? And, you know, as a passive investor, you maybe then start doing some private real estate. Maybe you start doing some private equity, and venture capital is a little more out there, right? And then you have the people on the coast like you, that probably the only thing you've ever invested in is venture capital, right? But it feels a little bit like gambling, right? It's like, you know, to pick a portfolio company and money, it's kind of wildcatting, you know, and so how do you pick the right manager? And as a skeptic, right? And a guy who's actually, my background, I raised $44 million in venture capital with a previous, in company. And well, I'm a computer scientist, so I understand the whole, all that space, but it's really hit and miss and very risky investment. So where does venture capital fit in a portfolio? Let me just ask that. Where does it fit? I mean, it shouldn't be 100%, right? Although I think people in the space, that probably is where they're at. But hey, how does it fit? And how do you de-risk it?
So I think taking a step back, you know, different people are going to have different goals, right? So if you're a pension fund, you know, you're managing millions of people's retirement money, and, you know, ensuring that they'll have money when they retire. So you're not going to go all in on venture. And, you know, what they have at the institutional level is portfolio construction, right? So they have mandates and they have processes around that in terms of like what actual percentage goes to venture, what else goes to stocks, you know, bonds and commodities. So at a professional level, there's portfolio construction that's created as an angel or like a high net worth individual, someone who works at Amazon or someone who works at IBM. These people make around 200, 300K a year, right? Or whatever, maybe more, right? These tech operators, medical doctors, lawyers, high net worth individuals, accredited investors. You know, again, what are your goals? Are you, and what is your tolerance for risk, right? Because you could, you know, it does sound like gambling, right? I mean, it's high risk, you know, but there's frameworks that you can put in place for venture. And, you know, again, you know, I'm not a financial advisor. So I wouldn't be the right person to prescribe that, but I think, you know, you want to think about your goals and your tolerance for risk. You know, I would say venture in general is just, to your point, just a very risky asset class, right?
So how do you de-risk it?
So there's a few things that I've done in my process, right? I mean, I look at the market size, I look at the team, I look at the traction. Normally when I invest in startups—
Now, this is for a portfolio company, or
these are for
VC managers?
companies. Yeah, these are, I'll talk about both, right? So I say for portfolio companies, again, everybody has a different strategy, right? Some people do pre-seed where they're all in on just the founder. There's no traction. There's no revenue. I'd like to see some revenue. Yeah. So I like to see some revenue.
So just let's have a, you know, an intro moment here, right? We love to bring our investors along and, you know, and get rid of the vernacular. So so there is venture capital investing falls into kind of a spectrum based on the size of the company and the maturity of the company. So pre-seed, I haven't even heard that word, is basically a guy with an idea, right? He's waving his arms, you know. Seed is really more of a concept. You know, then, you know, I'm not sure what categories you would say, but then there's really growth stage where in concept, it just needs capital. And then it's late stage, which is really very, very mature teams, very mature strategies, and more of a pre-IPO. Then there's MES, which is really pre-IPO and bridge kind of funding. And they're various sizes. So $100,000 might buy you, you know, 2 or 3 or 4 or 5% of a company at an earlier stage. It buys you, you know, away from the CEO at the later stage. So, you know, is that accurate, or you know, give me your perspective on that?
Yeah, that's right. I mean, I would say pre-seed, a lot of times, people who invest in pre-seed are, spectacular people. Some of them might have had a business in the
Right.
past. So like if Travis Kalanick, right, from Uber is like, look, I'm launching, I crushed it with Uber. I crushed it with Cloud Kitchens. I'm going to change education.
Yeah. So you're
You got to have the website.
talking in that case, you're saying whatever he does got a good chance of working. And so I'm going to throw some money at it.
Yeah. So you're investing in people, and the benefit of doing pre-seed, obviously, I'll give you an example, right? If you invested, there's a chart that I saw a while back that listed the early investors. This might give you some perspective. The early investors of Uber, right? So it was, Jason Calacanis was one of the investors, and I think he got like $25,000 from Sequoia Capital, and they gave him like $25,000 worth of shares. And they had a graph that showed how much that turned into, right? So $25,000 early, if you waited 10 years, that would have been 125 million. So I think that's like 5,000x, right? So yes, it's risky. It could be gambling. Uber could have failed, but also there's a different perspective, which is like, what if it doesn't fail? So if you think in a positive light, it's like, look, I have some capital that I'm going to put into growth opportunities. And, I'm going to bet. I'm going to bet on my ability to invest. I'm going to bet on this person.
The
I
moonshot.
believe in this person.
Yeah. So it's taking a portion of your capital and putting it on red 19.
Yeah. And I think that's the spirit of the American dream. That's the spirit of entrepreneurship, right? It's risky to start a business and you're betting on yourself. So yeah, I mean, I wouldn't say like it's gambling, but I would say you're believing in something and you're backing something because you have conviction. And
So
you don't have
doesn't it make more sense, I guess my advice to an investor would be, if you know a space, if you're an expert in food technology, then do angel investing, or seed or pre-seed in food technology, because their space, the risks, you understand that, or if you're a computer scientist or what. So if you know something, then go in.
Yeah.
And if you don't, do not go in as at that level. And then if you don't know, if you're not an expert in the area, then you really want to invest in a fund, and because you get diversification, right? I was the first venture capital in my business in the late 90s was a guy who was a founder of Savin Rosen, one of the top VC funds of the early tech era. And they had 100x returns, or 100% returns, in their LPs over the course of decades. And their model was one in 18 deals. They only cared about the one deal that went 100x. And if they went 5x or 10x, they didn't care.
Yeah.
So it's really, if you're doing that, you have to have a portfolio. There has to be you're placing a lot of bets on the table, right? For the one that's going to hit. So doesn't it make sense to pick a fund or a couple funds if you're going to do this, or unless you really are an expert and the exact company you're investing in?
I think it depends on your goals. So I think, the benefit of going direct obviously is it's not a diversified product, right? So it's a direct deal, like you're directly in Uber. Uber has outsized returns, right? But the risk is the risk, right? So going into a fund is a risk-adjusted opportunity, and you can also learn, right? So I'll talk about my example, right? I have deep tech experience and I have fintech experience, and I worked in fintech in New York for some time. So to your point, Bob, like when I started investing, I did focus on deep tech and fintech because those are the areas I knew. But I started becoming really curious about food tech, so I've done some, companies in food, and, the way that I build knowledge around that was I talked to Ron, so I think if you want to expand your portfolio to new sectors, I think the way to do it is go down the rabbit hole, read a bunch of blogs, listen to a bunch of podcasts. And it's not that difficult eventually on your own to study and become an expert, but then you could also expedite that from having experts that have invested in that industry to share deals with, because they know the industry, they're kind of vetting them for you. And then there's also angel groups, right? You can go to angel groups as kind of a community of people that are sharing their concerns about the risks in the groups, and they're investing together, right? So they're taking a risk and they're betting on this company together, and they're doing the deal. They've done all the diligence together. So I think all of those things kind of help to de-risk. But yes, funds, the interesting thing about funds is you can quickly learn a type of industry very quickly, and it's also risk adjusted. There's also some types of LPs, I would say endowments, that cannot invest in funds because it's too risky. So they have to invest in fund to funds, which is an index of an index. So again, so it depends on your goals and also like what you're trying to achieve. If you're trying to achieve outsized returns and a 5,000x return, probably, a fund on top of a fund is not going to help you drive that. And then, also like, do you want to get exposure to real estate? And, do you want to have monthly recurring revenue from like rental properties, right? So again, I think you want to think about holistically what's important to you and what your goals are financially, and then kind of build a strategy around that personally.
Should someone go about picking a fund manager? Let's say they, I'm saying, I don't know anything about the space. I want to play. I want in the VC world to learn. I don't want to risk. I don't want something risky. I just want to play. And I mean, there's thousands of these fund managers. I mean, I was looking the other day on Angel List, which is kind of a community, an angel investment community. And you can kind of say, hey, you can raise your hand as a fund manager and say, I'm a fund manager, and start these little micro funds. And there's thousands of these guys, and there's, I don't know how many thousands of investment funds, right, of venture funds. So, it's navigating that. It's where do you stick the fork in? What's the best way, to learn about this and to find a manager that you can do well with?
So I wouldn't say there's some golden, rule, but what I think has been successful on both sides, as an LP could be an emerging LP. That's kind of a term that I've been hearing thrown around. We've had these IT professionals, doctors, lawyers that are making a couple hundred grand a year. They probably can budget maybe investing 50K a year or 100K a year, right? They've traditionally done startups. Now there's a whole movement of kind of like these angel LPs where, to your point, maybe what you were alluding to is they back these smaller funds, and some of these funds have smaller minimums, right? Traditionally, funds usually have a bigger minimum to get in, right? You have to do a 250K check or 100K check to get in as a minimum. But now there's these tech operators that are launching funds on the side. I just went to dinner with someone last night. I know two people that have worked at Google, and they've launched funds on the side. And so there's a whole movement now of people who have good jobs.
But that's not very comforting, right? It's kind of cool in one sense, and it's kind of ridiculous in another.
Yeah.
I'm an engineer. Let me start a VC fund, right? It's like, as an investor, come on, I'm not going to put my money in these guys. How do you place capital?
So, there's been some funds that have done really well. And, the thing is, they still need money to pay for their expenses, right? And to be honest, the only, when you have a fund, you're not generating monthly recurring revenue,
right?
Especially if you haven't raised too much capital. So you got to keep the lights on, right? So you got to do what you got to do, and everybody has to start somewhere. So what a lot of people do, there's two frameworks, right? You can be an LP, and you can work as a doctor or a lawyer, and, just take the money from your salary and keep doing that for the rest of your life. And hopefully you hit a home run, right? But then there's another school of thought that's like, look, you know what? Let me build my own firm. I think my goal, again, go back to goals. I'm a doctor, I'm doing well, but the moment that I stop going to the hospital, I'm not going to get that paycheck anymore, right? So how can I make, how can I generate some type of wealth? And I think, some people are looking at, building a syndicate, building a firm, and their goal, for some of the people, their goal is to eventually be a fund manager. And that was kind of what happened to me, right? I was an engineer. I got tired of going to work every day. And I was like, look, I'm really intrigued by the opportunity of private equity and VC. So there's doctors that are like, look, my goal is actually to be a private equity investor in healthcare and also invest in healthcare, but I don't know how to get there, right? I have this job, I'm trapped, right? I got a mortgage, I got kids. So how do I get there, right? So some pathways could be, let me do some small syndicates on AngelList. Let me find an interesting startup. And you know what? I talked to this startup. The startup likes me because I'm a doctor. I have this medical background. To your point, right? It's an industry that I understand, and I can add value to the founder. And I know a bunch of other doctors. They could probably part ways with like 10K checks. You talk to 5 or 6 or 10 doctors, and that turns into kind of a 100K check. And maybe that's how you build your track record, right? You got your first syndicate deal, and that's good proof to show that you can get people on board to invest in you, even though you have a full-time job. And I have a perfect example. So I can reference, if you guys want, a YouTube video. One of my friends who's at an institution, he backed 2 doctors that work at a hospital. They on the side built a hedge fund strategy on different types of drug discovery. And this institutional LP backed those 2 doctors because they have a unique alpha, because they have the industry expertise. They know about those drugs. So again, there's always a way to achieve your goals. You just got to figure out the creative way to do that. And sometimes it's not the conventional way, But-
it's actually so, most of our world is very into the real estate investing, right? And you read Rich Dad Poor Dad, and then you go, you buy a rental house, right?
Mhm.
And then you maybe buy another rental house, and then you get into multifamily. And at some point you need more capital so that you actually learn how to syndicate. And it's a very similar path, right?
Yeah.
On the VC side. So let's leverage my expertise
Exactly.
as food tech or biotech or doctor or whatever I'm really good at, and get into that space and look at building a viable little investment fund. That's really cool for the people that really want to get down and dirty, right? Roll up their sleeves
And those syndicates
and be active.
And whether it's real estate, look, you could do the same because I'm a fund accelerator, right? So I have real estate funds, I have hedge funds. It doesn't matter. As long as you have a fund, you're welcome at my community because it's all the same thing. You got to build a track record. So you can do a bunch of properties that you've invested in. You can showcase a track record and say, look, I've invested in like 20 properties. They're all making, $2,000 a month in revenue, and I'm profitable. And it's appreciated as well, right? So that's kind of my personal track record. And now I've done like 3 syndicate deals, and those deals, they're up by this much. Here's the track, so you want to create some reporting on your track record, how you're doing, because those are the data points that are going to indicate that you're a backable person to eventually launch a fund, right? And it's the same thing for venture as well. A lot of people, they're doctors, they're tech operators. They do a couple small deals on AngelList. Now they show that, hey, you know what? Like these deals have done well. This is kind of my technical track record.
It's 100% about track record. As a guy who's raised hundreds of millions in my day, and it's 100% about track record. It's like you gave the example of a Travis, Kalanick, and guy gets a big exit. It doesn't matter what he does next. People are going to throw money at him. Why? Because he has a track record, and that's an extreme example of it.
So this person had worked at a tech company. I'll give you a perfect example. I won't say the name or the person, but worked at a big tech company. On the side, launched on the side, what he did is he built a community. So I think community is super important because those are the people, and you guys are doing this now, right? But this person had a tech job full time because he had to pay the bills, right? But he knew that he wanted to be a fund manager, right? So he's trying to figure out a path. So what he did was he built a large community and started doing happy hours, right? Investor happy hours, built a community, built trust, added value to the community. And then he started a syndicate, and all those people were part of the community. They're sharing notes. And they started backing his syndicate deals. Over time, he had several deals that were done. Many of those deals were doing well. And, you want to include those people because they're smart people, right? Your LPs, a lot of them that are part of your community, they're smart, sophisticated people. They may even help you not make mistakes as well. Maybe you found a really amazing deal that's like in the insurance tech space, and you really love it. You love the founder, but there's a person that works in the insurance industry, and they're like, "Look, this is never going to work. I know the industry," and like that might have saved from like making a huge mistake. So that's where the community comes in, right? You do that, you do 20 deals, all those deals, some of them failed, some of them did well, right? But when you look at it from a portfolio strategy, there's a certain percentage IRR that you can kind of culminate together, right? That is your track record. Now you have a story. I'm this person. I built this community. I've done all this. I think I can raise a 10. And that person went on and they already oversubscribed their first fund. They're already on their second fund.
Oh, okay. So let's say I don't want to roll up my sleeves, right? I want to be passive. I just want to be in the game.
Mm-hmm.
Who's successful out there as an LP picking funds? How, really, you haven't answered my question of the tens, 20,000 of little funds. What's a winning strategy to pick one? Is it, it seems like it's probably purely relational based at this point.
Mm-hmm.
Now it's like, I know this guy, therefore I'm going to put money, but is that a good strategy? Doesn't seem like it would be. I mean, who's being successful as a limited out there? That's not just lucky, right? Yeah. And it's not picking a portfolio company, but picking a fund manager.
Yeah. I would say, like not to mention any names, but I would say there's a lot of fund of funds that have picked, winning managers. There's qualitative and quantitative things that you want to look for, right? So I think on the qualitative side, the most important thing is the deal flow. You want to judge a fund by the quality of the deals they have. Now, when you say quality, what's how well has that startup done? Have they raised a lot of money since they invested? Is there a large markup in the valuation? Like, what's the, there's kind of qualitative things that you can look for in the character of the person. When they say they're going to do something, did they actually do it? There's kind of a red flag that I picked up on this morning. There's actually an LP that was evaluating a fund, and the fund actually name dropped somebody. And when he talked to that person's like, I never heard of that fund before. So I think sometimes just, intellectual intelligence, emotional intelligence, some of those qualities of just kind of being someone that you can trust. Those are really the moving needles for investing on the qualitative side. What is their strategy? Is their strategy aligned to what you're trying to get exposure to, right? There's a fund that's focused on quantum computing. That's a really cool, sexy industry. But is that part of your goal as an LP? Are you trying to really get exposure to quantum computing? So I think you want to think about, for the smaller funds, some things that I think are really interesting are these funds that, have built these massive communities, because those massive communities are really people that are backing that fund manager. And that's just, I think it's just a really big indicator on that fund manager building something that resonates with the community and having a unique strategy. On the quantitative side, there's a bunch of quantitative factors, right? So like, what is the cash on cash return? What is the IRR? So there's not to kind of go deep into the rabbit hole of that, but there's performance metrics that different types of LPs look for, so I think the winning funds are the ones that combine both, right? And I think winning could be different for me. And, someone else, when I say this is a winning fund, somebody else may say, well, I don't, and that actually happened this morning. I was talking to someone, I was like, look, I love this fund. And I thought they were a winner. And then somebody else, their perception of winning is different, right? So I think it depends on what winning means for you, right? Is it just performance? Is it access to some of the hottest deals? That to your point, there's so many funds out there, right? And there's so many great funds. Some of the biggest feedback I give to funds is like, look, you're another Web3 fund. There's like 5 other Web3 funds that I've just interacted with. I'm going to a Web3 summit tomorrow. What is it specifically that you're doing, right? And I think it really comes down to content, community, deal flow, and then performance trumps all, right? So are you able to return capital to your LPs?
And I guess want to put a little bit of a cautionary note out there too for our investors. I was actually part of an angel group.
Yeah.
And it was a democracy, right? It was primarily doctors and lawyers who were very smart.
Yeah.
And they fell in love with different food tech deals and technology deals, and literally not a single one had any experience in food tech. And I was the only technologist. They voted down two of the deals, the technology deals I liked, that actually went out and did well. And they voted for a bunch of technology deals that didn't go anywhere. And they had 100% whiff track record, 100% voting. And this is really smart people making really stupid investments. And because you're smart, because you're a great doctor, doesn't mean you should invest in quantum computing. It doesn't mean you know shit about quantum computing, right? And you should probably stay away from it. And so I think there's a little bit of, we need to be careful about hubris and as investors and stick with something And
I think you always have, I think for me, I always, at the end of the day, I invest because I think it's something that I believe in. However, it's always good to get additional data points, right? So you get positive, negative data points. People hate the deal. People love the deal. There's been times where like everybody hated the deal and I still invested and I had, so I think at the end of the day, when you invest, and this is, again, talk to your financial advisor. This is not financial advice, but I'm just going to share what works for me. I just got to use my instincts and it kind of use data and just try to do the best I can on my own.
And I guess my advice would be, don't trust your instincts is more than experts, right? If you don't know the space, if you're not an expert in quantum computing, you should probably talk to a guy who is an expert in quantum computing.
And I think that's a good opportunity
because your gut is not going to help you.
But I think that's an opportunity to invest.
That's a BS factor, right?
Exactly.
A good salesman, I saw more technology deals sold to non-technology people, and they get wowed by the brilliance of somebody. And it's just fluff, right? It's hamburger helper. There's nothing underneath it. So, there needs to be, some caution too, right?
Yeah. And I think that's kind of where it, opens up opportunity to possibly invest into, if you're interested in kind of more general exposure, looking at fund managers that have a strategy on quantum or cyber. If you don't know the space, just surrounding yourself with experts, right? Like anything in food tech, like Dr. Ron, he knows those people, he knows the community, he understands like what the red flags are, right? Because he's just seen so many. And I think to build that skill, none of us were born like a private equity investor, right? We learned at some point, right? I wasn't like born and, I'm like, hey, I'm an engineer, right? Like you learn something at some point. So everything, you can learn anything, I believe, in this life. You just got to find maybe the right people that can train you or just find the right resources. And, anybody could be a quantum expert. They just probably got to spend a certain amount of hours studying it and, going to the right platforms to do that.
Well, I like your community approach. I think it's a way to get, to learn something and get with people and make yourself smart, right? Make yourself knowledgeable about the space and find out what other people are doing. And I sounds like a really good idea. And I like your idea of helping people start funds too, and every fund that's out there started that way with a guy that said, hey, let me become an investor. And
I think it's really just surrounding yourself with smarter people, right? I mean, and smart is subjective, right? I mean, there's book smart, there's people that are really smart in terms of building relationships. So I think unpacking smart could just be another whole podcast, right? But I think, look, there's a lot of people that have been super book smart. They've built really amazing careers, but when it comes to managing money and building wealth, maybe that department hasn't been because there hasn't been the education there, right?
So financial skill is a must. And if you're looking at portfolio companies and
the question is, this is the bigger, deeper question, Bob, like, why didn't we learn this stuff in high school?
True.
Like, wouldn't you want to know what budgeting is? And that's kind of a bigger, deeper question, but is that something that like should be added to education in the early days? I mean, I to be honest, I really learned financial management just from reading a lot of books. There's a book, I think it was like The Millionaire Next Door. those are really good books.
Yeah.
It had a lot of stories of couples like, thoughtfully saving money. They advise you to buy a car that's 3 years old. So there's just a lot of cool content out there. But, I feel like unfortunately it's usually self-study or now with,
Or fortunately, I mean,
yeah,
because the truth is for $15, the price of a book, right?
yeah,
Whoever will tell you their deepest
mhm,
secrets and their
yeah,
most glorious
hmm,
successes and worst failures and how to avoid them. And so, yeah, I do think that's actually a key, right?
hmm,
Is to be an avid reader and yeah, I mean, I've raised lots of money and I never went to school to learn how to raise it, right? There's no course to take, learn how to raise
yeah.
money, right? So good point. I think we can improve on that.
Yeah, I think look, raising money. This is another maybe controversial thing, but I think one of the most important skills is sales. So
Totally.
with sales, you can get a job offer, you can raise money, you can probably find a spouse, probably find a date. And I think you're really helping, and you're also kind of I think that and then just solving problems, right? So if there's a problem, one problem is, hey, we're facing 8% inflation. How do you mitigate inflation? Maybe it's not always just investing in the FANG companies. Like, are there other opportunities that can provide growth and outsized returns to augment inflation? Right. So I think, and then I think a new thing, which the Gen Zs are figuring out, is communicating that in 15 seconds, right? We're doing long form content here. Sometimes the Gen Zs, what's most engaging, you're seeing now people watching Netflix, but they're actually on their phone scrolling TikTok and they're not even watching Netflix. So I think, another big thing that's going to be super important is concatenating a message in like less than a couple seconds. And, like that combined with sales, if you go to a family office event or some type of capital allocator event and you're trying to connect with somebody, you're not going to have time to do a long form message or pitch, right? You really need to kind of help them understand, who you are and what you're doing in a couple seconds. So I think that's definitely like when it comes to content and communication, short and sweet is sometimes more. But I guess all of these are just my opinions. I could be wrong. So
Well, Joel, thank you so much. This has been very enlightening and very very cool how you built this community. Both for fund managers, LPs, and just education around it all. What's the best way? You run a podcast as well. I think it's called Future One.
yeah.
That you talk about a lot of these topics in more
Mhm.
depth. You have guests on, and then
So yeah, you can go to suttoncapital.co and you can go to free resources, and then free resources, there's a drop down to just see videos. And I do a web show every week. I usually have, 1 to 2 investors. This has been a fun experience. I actually haven't been interviewed in a while. I've been busy interviewing other people. So it's an honor to be here and share my story, and appreciate you guys, um, you know, spending time with me.
And
yeah,
if someone's interested in kind of joining your community,
Mhm.
what
Yeah.
what would the approach be there?
Yeah, they can join our website. They can contact us on our website. There's a Slack channel that we have as well. So all of that is under free resources. Yeah, I mean, a lot of our content is available for free, on the internet. I'm Joel Palathinkal. They follow me or connect with me on LinkedIn, on Twitter. At Joel Palath. So whenever I find something interesting, I always post it on social. Um, so yeah, I mean, the community, the content's there. So hopefully it's valuable to some people.
awesome. Well, Joel, thank you so much for coming on, and
Sure.
maybe we'll have you back on talking kind of 2.0 here later on. So appreciate you coming.
Yeah, absolutely. Take care, guys. Thanks a lot.
Thanks.
Bye.
All right. Well, that was really fun bringing on Joel to talk about the kind of community he's built in this exciting space of venture capital. So definitely really cool what he's done in kind of the whole approach that he's taken with kind of building community, and not only just on the portfolio company side that he's looking for investments, but also helping fund managers and also helping limited partner investors being able to kind of work together and learn and gain insights from each other. I think it's a really cool approach.
I thought that was interesting. The idea of kind of building your own VC fund, I mean, as a way to do it.
Well, it's cool. Like even seeing a lot of the trends and the shifting we've seen in the real estate side of things from, it's getting easier and easier to raise capital and, for the barriers to entry continue to decrease as more people get educated and even doing it as a full-time job. I'm a mastermind with, a lot of capital raisers.
Seems very cool opportunity, but maybe a cautionary tale as well, right? Should everybody start their own venture capital fund?
No, I love that.
And my risk meter is just pegging the needle, but there's going to be some wins out of that too, right? So
right, yeah, it's it's the good with the bad. It's the democratization of the industry a little bit, but with that comes, not only bad actors, but just inexperienced actors that have hubris or maybe don't have the experience to even know what they don't know and can get into trouble. But, it's exciting from a macro standpoint because I do think this is a space that, you and I are personally very interested in, but it does feel like there's this, great divide of how do you bridge the gap of actually
how do you make it not gambling? That's what I'm looking for. Cause
right.
It is, it's like, oh, it's all, you always tell the story about the guy who invested in Uber and made the 1,000X or 5,000. Okay, great. But for every guy that did that, there's a million guys who did the opposite and lost everything. And, so how do you do that? And, I'm still on the hunt for that. What's the strategy to play this space? I do think it's, staying in an area where you are an expert and as an angel investor is a winning strategy. If you have the bandwidth to be an angel investor.
Yeah. Well, I think you made the point too. Like there's the spectrum and as you want to de-risk, the way you de-risk is by investing in funds or fund of funds that are diversifying in a bigger portfolio. And the more expertise you have in a particular area, maybe the less of that you do and the more direct you go to the actual companies themselves. And, you kind of pick and choose along the way. But no, I think I like what you said too. I mean, it's a little bit of a cop-out answer of, just one of your personal goals, right? Which he's right. I mean, it is someone at my stage of investing can withstand a lot more risk as someone who's, later at it. It's just with a lot of capital, right? But generally in my mind, venture capital dollars that, are allocated personally are ones that I'm okay losing, so
that there you go. And I'm curious, I'm just looking at you while we're doing this interview as you're the banker, right? You literally were a commercial banker who underwrote hundreds of deals and, you're disengaging that whole part of your brain to do any of this investing, right?
Not even disengaging. It's just, it's a different risk reward profile, right? In banking, you can't have any downside. So you can't take really any risk. But in this, if you're using dollars that you're okay losing, then, hey, this could be a 5,000X return and that's okay, but I'm not going to bank my life savings or my entire future on it. So I think it's,
Well, Ben, these listeners that want to play, what do they do? How do they jump on board?
Yes. Well, obviously you can reach out to Joel and his kind of cool community there. And most importantly, if you've not subscribed to this podcast to get the best education around alternative investments, you need to subscribe to Invest Like a Billionaire on any platform you listen to. And please share it with all your friends and family. We're trying to share the knowledge here. So help us in that journey. Thanks so much for listening.
Help us give the love out.